Hello everyone, welcome to another edition of Skybound Capital's podcast series Under the Macroscope, and thank you to those of you who've sent in your feedback after the first edition with our chief strategist Jabir Sadawala in the London office. We got some great responses, some very interesting questions to come out of that podcast as well. And as we did in that first episode, we'd encourage you to keep in touch, send us your questions, send us your comments and your views on the topics that we discuss. We really do not intend this to be a one-sided affair. We'd like to make it as interactive as we possibly can and address issues that you would like raised, and for members of our Skybound Capital team, most notably the research team, to discuss. And that's where we're going immediately with episode 2. And this has been quite a contentious topic for some time. I think there's been a lot of cynicism around it, and that is the topic of carbon credits, the concept of almost being able to buy the ability to emit more carbon than perhaps you might otherwise do as a business. And it's become a tradable commodity globally. And there's been a lot of talk around this, a lot of contention, as I've mentioned. And 2021, you could say, was a defining year for carbon markets as an asset class, making the headlines both in terms of performance as an asset class and in terms of climate impact. So there's a lot of buzz, a lot of talk around carbon prices, and a member of the Skybound Capital research team, Josie Davis, takes a specific interest in this space. She's been on the podcast series before talking about ESG. She is very in touch with a number of environmental issues. So Josie, great to have you back on the podcast, and tell us a bit about what is happening globally in the carbon credit space at the moment.
Thanks for having me back, Matt. So yeah, this is a topic I'm really interested in, and it's something that's been in the news a lot recently. So 2021 really placed carbon on the map as an emerging asset class. It started the year trading at 34 euros a ton. Sorry, I'm talking about European carbon futures, and ended the year closer to 80 euros, and last week reached an all-time high of 96 euros per ton of carbon. So basically in the 2021 year, the price of carbon more than doubled. And it's very exciting because the higher the price of carbon, the higher the cost of producing planet warming emissions. And as you know, we are trying to reduce emissions to try and curb global warming. So yeah, very interesting topic. And the price of carbon is expected to rise further to reach the carbon targets that have been set.
Okay, so before we go any further, why does carbon have a price, and how does the market work? How has it evolved?
So basically putting a price on carbon puts a price on emitting these emissions. And as I said, we need to try and reduce emissions. So as the price of carbon rises, it incentivizes businesses to reduce their emissions and invest into green technologies. So to kind of understand the markets, there's two types of markets. There's the compliance market and the voluntary market. And I'll start to talk about the compliance market because it's a lot bigger and it's more liquid. And basically the compliance markets are administered by governing bodies. So in Europe, it will be the European Commission, and one of the markets in America is administered by the California Air Resources Board. So if we move to the EU, basically the compliance market covers factories, power plants and airlines. And basically companies in these sectors are awarded a certain amount of credits that they are allowed to, so they're allowed to emit a certain amount of carbon. And if they emit more than that amount, then they have to buy credits to offset that. Mm-hmm. So for example, Ryanair, which is an airline in Europe, had to spend 150 million euros last year to offset the carbon credits offset the carbon emissions above their allowed amount. And this is before prices doubled. So really can be quite expensive and influence business decisions.
But do you buy my relative cynicism that I referred to in the intro here, the concept of being able to buy your way out of a situation without physically reducing your emission?
I don't think I 100% agree with you, because I think that as the price rises, companies will be incentivized to cut their emissions rather than pay up that cost. So
no, I'm happy to be proved wrong. I just think I perceived cynicism out there, but what you're saying is that these markets are becoming more popular, they're growing. So how big are they right now?
So the voluntary market, which I haven't spoken about yet, so actually let's start with the compliance market. The value of traded global markets for carbon dioxide on the compliance markets grew 164% in 2021 to reach 760 billion euros, which is $851 billion. And 90% of that global value came from the European emissions trading scheme. So that's definitely the biggest market. And then there's a graph that will come up now, and that shows the voluntary trading market. And the voluntary trading market up until the end of August last year reached $748 million of turnover, which brings it to a cumulative $6.7 billion at the end of August. And then at the end of the year, which isn't included in this graph, the voluntary market actually topped $1 billion in turnover for the first time, up from 300 million in 2019. So it's very big and it's growing, and as more markets are added, it will continue to grow.
It's not only growing, it's growing at a pace. So put the cynic firmly in his place, Josie. Put him in his place. Is it having the desired effect? Is it having the effect of reducing total emissions globally?
Yeah, I think that it's starting to, and I think that it will continue to. So in the compliance market, I mean, if companies are forced to, if the price of carbon is rising, they would surely prefer to invest to actually reduce their emissions than pay for these offsets if the price of reducing is less than the price of the offsets. And I think, I don't know if you've heard, a lot of companies, and this more refers to the voluntary market, but a lot of companies have committed to become net zero, which means that they have to buy offsets to reduce their emissions or reduce their emissions themselves. So I think that increasingly, as the price rises, as investors are becoming more interested in it and are basing their decisions on companies off of a company's commitment to reducing climate change and becoming net zero, I think that it will incentivize companies to reduce their emissions.
So you've spoken about the growth in the size of the market, but also substantial growth, as you pointed out earlier, in the price of carbon. Why is that the case? What is driving the exponential rise in the price of carbon?
So last year, there were a couple of things happened that contributed to this rise. So one of them was the price of natural gas. So natural gas was one of the only markets that actually grew more than carbon in 2021. The price of natural gas, I think, rose more than 300%. And so a lot of companies that are covered in the compliance market in those sectors had actually switched from using coal as a power source to using natural gas, because natural gas releases less emissions when it's used. But when the price of natural gas rose so much, they had to switch back to carbon, which meant they released more emissions and had to buy more offsets. So that increased the demand for the credits or the offsets, which obviously pushes the price higher. Another thing that happened is the EU announced their Fit for 55 package, which entails reducing the bloc's carbon emissions by 55% by 2030 relative to their 1990 levels. And so this includes a number of market reforms in the carbon market, which includes a cap recalculation. So they're going to bring that carbon allowance down, which means the companies will have to buy more credits to offset their emissions. So that also, just the anticipation of the increase in demand, pushed the prices higher. And then at COP26, they also agreed on a number of things, which included creating an international carbon trading market. And then, of course, the net zero pledges by lots of companies. Also, just all these things are contributing to an increase in demand, or an anticipation of an increase in demand, which pushed the price higher.
But now what would fascinate me is even just one practical example here, because I've heard talk around the corridors of the office of companies provisioning for the cost of carbon credits, and in some cases radically underestimating the scale of the growth in the price, and possibly leaving them in extremely awkward positions financially should they be forced to buy the necessary credits to make them carbon neutral. So is there a practical example you can give us in that regard?
Yeah, so I'll speak about Exxon in a couple of minutes, but first, so you're referring to the voluntary market where companies aren't covered by the compliance market, and they're kind of doing this, either they've adopted a net zero stance or they're trying to incorporate what the cost of carbon is to think about where they stand relative to the mandatory regime. So in the voluntary market, the price of carbon is a lot lower. I think the median was about $25 a ton. But so companies are doing it differently, but an interesting example, which I think is the one you're referring to, is Exxon. So I don't know if they have actually started to provision, but they are one of the world's top emitters, the massive oil company. And in 2021, in 2020, they released 112 million tons of carbon dioxide and other greenhouse gases. So if they were covered by the compliance market and had to buy these offsets at $100 a ton, it would cost them $11 billion annually. And taking into account that their average annual earnings are about $8 billion, I don't think it would be a good situation for them. So it is something that companies have to start taking into consideration, potentially if they were covered by the compliance market.
And from what you've seen, Josie, and observed, who's investing in carbon? Are we seeing it? I mentioned earlier, it's emerged almost as an asset class on its own, and we've seen it being used by hedge fund managers, for example. Who is driving the interest in carbon as an investable asset class? Yeah, so there are a number of now carbon-based exchange-traded products. I think I'm not quite sure the value of those, but I'll touch on two examples that I found. So one, as you said, is a hedge fund by a company called Northlander, and they have about $354 million of assets under management. And last year, based on their bets that the price of carbon would increase, they returned 148% to their investors in 2021. And they have said that they expect carbon to be trading around $140 to $160 a ton later in this year. So that's an interesting hedge fund, obviously not available to every investor, but one of the biggest carbon ETFs, or the biggest, is the Crane Shares Global Carbon Strategy. So they returned 109% in 2021, and they had $1 billion of inflows during the year. So now that ETF sits at about, I think it's $1.6 billion. So they have exposure to compliance carbon markets. So they have exposure to the EU and the 2 US regional markets, and they recently added the UK's market. And it actually, their return profile shows significantly less volatility than the individual markets, because the different carbon markets tend to be quite uncorrelated to each other. So yeah, as the price of carbon continues to rise, which it is expected to, I think that these types of products will do really well. So the importance of having a carbon price is proving itself. And in your opinion, in closing, is it having the intended effect? Are we heading in the right direction with the evolution of this market? I think we are heading there, and as people become more aware and more markets are developed and more people enter the space, it will be something that is closely watched. And I think that if companies have to kind of interact with these markets, it's going to push them to reduce their carbon emissions and invest into sustainable assets rather than pay for the offsets. So I think that it is having the intended effect, and hopefully it will continue to and actually produce substantial reduction in emissions. And for investors, it's an opportunity to add something to your diversified portfolio. So I think definitely something to watch. Well, that's good news to finish with, and especially coming from you, because I know how passionate you are personally about this space, and you've even done a job in trying to reduce the slight cynicism with which I came into this podcast. So 15 minutes ago, I was less convinced than I am now. So I guess that's a good thing. But as always, it's a space that Josie and the rest of the research team at Skybound Capital will be keeping a close eye on. Great to chat to you again. If you want to subscribe to the Under the Macroscope podcast, please do so on Apple, Spotify, or the Google podcast platform for Android, or you can go to Skybound Capital's website at www.skyboundcapital.com to be able to review all past editions of Under the Macroscope and also look at some of our other multimedia offerings. Skybound Capital is a business that is globally focused. We have offices in Cape Town, South Africa, in London, Mauritius, Australia, Hong Kong, and offer a variety of wealth management solutions. We've got a fund management portfolio which really focuses on private capital, which is a term that we coined to encompass debt and private equity and real estate. And we also have wealth management solutions in all the territories in which we operate, advisory solutions, where we like to be able to provide solutions to clients and their wealth management needs. So for any more information on Skybound Capital, again, go to www.skyboundcapital.com, and we look forward to welcoming you to the next edition of Under the Macroscope. Have a great week.